Greetings candidates and welcome to the lesson. Today we continuing with the topic mergers and acquisitions. The subtopic is valuation of firms for mergers and acquisition purposes. We've been looking at various methods that can be used to value targets for mergers and acquisition purposes. So far we've covered the net asset basis method, the PE ratio basis. We've done the dividend growth model. Today we are moving to the fourth method, which is the super profits model. The super profits model. The super profits model. Now, this model is often referred to as the excess earnings method, also known as excess earnings method. It is also known as the excess earnings method, and it is a valuation technique primarily used in mergers and acquisitions to determine the value of a company's goodwill or intangible assets. Okay? This method is used to value a company's goodwill or intangible assets. And it operates on the premise that a company generating profits consistently above the normal rate of return for its intangible assets is doing so due to some inherent intangible advantage. You understand, candidates? This method is premised on the fact that a company generating profits consistently above the normal return for its tangible assets is doing so due to some inherent intangible advantage. And the model posits that if a business earns more profit than what a similar business with comparable tangible assets would normally earn, that is what you are referring to as excess earnings or excess profits. So if you have two businesses, A and B, and these businesses have similar assets, company A, company B has similar assets, it operates in the same industry, but company B earns more profits, okay, then that can be attributed to intangible assets like brand reputation. If company B earns more profit than company A, yet they have similar assets, then the method posits that company B could be doing so because of, could be earning excess profits compared to company A because of intangible assets like brand reputation, intangible assets like customer loyalty, or skilled management, or just efficient processes. So the model then capitalizes these super profits to arrive at the value of the intangible assets or goodwill. You understand? Excess earnings method. We are discussing the excess earnings method as one of the methods that can be used to value firms for mergers and acquisition purposes. Now, how is it used? How is this method used? How it's used, or when do we use it to value targets for mergers and acquisition purposes? Now, candidates, the super profits model is not typically used to value an entire company for mergers and acquisition purpose. You understand? It is not used to value the entire company for mergers and acquisition as a primary method. In the same way we have the discounted cash flow method or the PE ratio method. Instead, its main application is in valuing goodwill. Valuing goodwill, because you recall, like the net assets method, that method we use it. If you are to use that method, let me use the net assets value method. We say that this method we calculate the value of a target company by subtracting the fair market value of liabilities. The fair market value of liabilities, you subtract that from the fair market value of assets. That is the formula for calculating the value of a firm using the net assets valuation method. So here we are saying that the super profits method is not used to value the entire company, but is only used to value this thing we are calling goodwill. This is its most common use. So how is it used? Number one, valuation of goodwill. In mergers and acquisitions, we use this method, number one, to value goodwill. Valuation of goodwill. Valuation of goodwill. When an acquirer pays a price for a target company that exceeds the market value of its identifiable net tangible assets, that is assets minus liabilities, then the difference is recorded as goodwill on the acquirer's balance sheet. And the super profit model can then help to theoretically justify and quantify the goodwill. So if A is acquiring B, and B's net identifiable assets, the net identifiable assets is equal to fair value of assets minus market fair value of liabilities. The difference is the net. If A pays in excess, assuming this is 10 billion, if the net assets value is 10 billion and this company A, while purchasing company B, buys or pays in excess of 10 billion of, say, 11 billion, instead of paying the net identifiable assets, which is 10 billion, and pays 11 billion, that is an excess of 1 billion, then this excess billion, the excess 1 billion, candidates, the excess 1 billion in this case is what we are referring to as goodwill. It's referred to as what? Goodwill. When an acquirer pays a price for a target company that exceeds the fair market value of its identifiable assets, the difference is recorded as goodwill in the acquirer's balance sheet. So this is a difference of 1 billion and is equal to goodwill. So this goodwill of 1 billion will be recorded in the books of the acquirer because it is A that is acquiring B. You understand? And the super profit model can help to theoretically justify and quantify the goodwill. So that is one application of this model in mergers and acquisitions. The second application is valuing small businesses. Valuing small businesses and professional practices. Valuing small businesses and professional practices. Now, for businesses with significant intangible assets, for example, strong client base in law firm or a renowned brand in local, say, rent or business, where comparable market data might be scarce, then the super profits model can provide a reasonable estimate of the intangible component of value. Valuation of small businesses and professional practices like accounting firms, the law firms, okay? The business that do not have identifiable tangible assets. Businesses whose assets are majorly intangible, then the super profits model is ideal for valuing such businesses. So that's the second application of this model. The third application or use is informing purchase price allocation. Informing purchase price allocation. Now, after a merger deal or an acquisition deal, the purchase price must be allocated to the acquired assets and liabilities for accounting purposes. After a merger or after an acquisition, after company A acquires company B, the purchase price must be allocated to the acquired assets and liabilities for accounting purposes. Like the example I gave, A acquires B at 11 billion. That is a lump sum. Now, this 11 billion has to be allocated in the books of company A for accounting purposes. And it is this super profits model that provides a basis for valuing the intangible assets that contribute to the super profits, thus helping in the allocation process. That is the third use of the super profits method or model. You understand, candidates? For dispute resolution. This method can also be used in dispute resolution or just tax purposes, for tax or tax purposes. Dispute resolution or tax purposes. Now, in some legal or tax contexts, for example, in divorce settlements or estate valuations or specific tax rulings, this method might be prescribed or accepted for valuing the intangible component of business. The intangible component of business. So this is 4 ways in which super profits model may be used for mergers and acquisition purposes. Now let's learn how this method may be used in calculating value of a firm for mergers and acquisition purposes. Calculation. Now, the calculation of goodwill using the super profits model typically involves various steps. And we are going to highlight the steps. The first step is determining net tangible assets. Step number 1, determine net tangible assets. Net tangible assets. Determine net tangible assets. The first step is to calculate the fair market value of all identifiable tangible assets like cash, like accounts receivable, inventory, property, plant, equipment, motor vehicles, and so on. That is the tangible assets. So net tangible assets will be equal to the tangible assets minus the market value of all liabilities. You understand? Yes. Minus all market value of all liabilities. That will give you the net tangible assets. That's where we get the word, this net, because you are getting the net, the difference between the tangible assets and the tangible liabilities, the total. That will give you the net tangible assets. So step number 1 is to determine the net tangible assets. And you get the net tangible asset by subtracting the fair market value of liabilities from the tangible assets. That gives you the net tangible assets, or capital employed. It's also known as capital employed. That is step number 1. The net tangible assets or capital employed. Step number 2 is to calculate the normal rate of return. Calculate normal rate of return. Calculate the normal rate of return. Step number 2, calculate the normal rate of return. Determine the typical rate of return that a similar business with similar tangible assets and risk profile would earn in the industry. And this is often based on industry benchmarks, on average returns on capital, or risk-adjusted rate for tangible asset investments. And this is a crucial and sometimes subjective input. Then step number 3 is to calculate the normal profit. Calculate the normal profit. Step number 3, calculate the normal profit. And how do you calculate the normal profit? Normal profit is equal to this, the product of these two. This is equal to, this normal profit is equal to the net tangible assets times the normal rate of return. That will give you the normal profit. Multiply the net tangible assets by the normal rate of return, and that will present the profit that the company should earn based solely on its tangible assets. Solely based on its tangible assets, because we are applying the normal rate of return on the net tangible assets. Step number 4, in calculating the value of a target company for mergers and acquisition purposes, is to calculate the average or actual profit. Calculate average actual profit. Calculate average actual profit. Calculate the average actual profit. Now, the average actual profit is sometimes referred to as maintainable profit, also known as maintain profit. Calculate the maintainable profit. Calculate the average actual profit. That is to mean, determine the company's average historical or projected sustainable profit. For example, the net income or operating profit. And this profit should be adjusted for any non-recurring items or owner-specific compensation to reflect the true operating earnings. In most cases, an average of profits over the last, say, 3 to 5 years is used. You take the profits of the firm for the last 3 to 2 years, get the total. For example, year 1, year 2, year 3. Get the operating profits, then divide by 3. That would give you the average actual profit. We are looking at the historical operating profits. Actual, historical. Determine the company's average historical or projected sustainable profit. It could be actual or projected sustainable profit. So you can take 5 years, use the past data or past financials to calculate this actual profit. You understand? It can be average actual profit or maintainable projected profit. Then step number 5 is to calculate super profit. Calculate super profit or excess, also known as excess earnings. Calculate super profit or excess earnings. And how do you do that? You subtract the normal profit from the actual profit or maintainable profit. Super profit is equal to the actual profit minus you get the difference between the normal profit, that is the normal profit, you get the difference between the actual profit and the normal profit. Yes, normal profit. That will give you the super profit. Subtract the normal profit from the actual profit, and the difference represents the excess earnings generated above what's expected from the tangible net assets, from the tangible asset base, Then step number 6, candidates, is to capitalize super profits to find goodwill value. Capitalize super profits. Capitalize super profits to find. Why do we capitalize super profits? To find goodwill value. The purpose is to find goodwill. We capitalize super profits to find goodwill value. And how do we do that? How do we capitalize super profits to find goodwill value? Now, the super profit is then capitalized by dividing it by a capitalization rate. So goodwill value, that is to mean goodwill value will be equal to the super profit. We divide the super profit by a capitalization rate. It's just equal to super profit divided by a cap rate, the capitalization rate. You capitalize the super profits to find the goodwill value. You understand? You understand, candidates? The super profit, I repeat, is capitalized by dividing it by a capitalization rate, and this rate represents the rate at which the intangible assets are expected to generate value, and it can be the normal rate of return, it could be a higher risk-adjusted rate, or a year's purchase multiple. A year's purchase multiple. Then lastly, step number 7, and by there is an alternative way here for those of you who are studying financial reporting. There is an alternative way of calculating the goodwill value. If you have been attending financial reporting classes, then you can recall that an alternative way is to have a number of years purchase. The super profit will be equal to number of years purchase. Instead of, it can be used where goodwill, we calculate the super profit. We multiply the super profit. Alternatively, we can multiply the super profit by number of years purchase. You understand? An alternative way of calculating the goodwill value, I'm saying you get the product of the super profit and a number of years purchase. Then step number 7 is to calculate total business value. Calculate total business value. Calculate the total business value. Step number 7, calculate the total business value. Now, how do we calculate the total business value? The total business value could be equal to the net assets, net tangible assets. This is just equal to the net tangible assets plus goodwill value. That's simple, candidates. The total business value, because here we are valuing a company. you take the total net tangible assets, you add the goodwill value. Because you recall we say that this method primarily values goodwill. So the total business value can be estimated by adding the goodwill value to the net tangible assets, such that the total business value will be equal to the net tangible assets plus the goodwill value. So that is a formula for calculating the total business value. Candidates, we are studying various methods that can be used to value firms for mergers and acquisition purposes. We are on the fourth method, which is the super profits model. The super profits model, or the excess, is also known as the excess earnings method. The excess earnings method. We began by saying that this method is primarily used in mergers and acquisitions to determine the value of goodwill or the value of intangible assets. That's why in the last stage we have the tangible assets plus the intangible assets. That will give you the total value of the firm. The net tangible assets, these are the tangible assets. Then you add the intangible assets, which are represented by the goodwill. This method does not entirely value a firm or a company. No, it is only used to value the component of the intangible assets. Now let's move to discuss the advantages and disadvantages of this method. What are the advantages of valuing a firm using the super profits method? One, this method explicitly values. It explicitly values tangible assets. It explicitly values tangible assets. This method explicitly values tangible assets. That is an advantage. It directly attempts to quantify the value of intangible assets. Okay? It directly attempts to quantify the value of goodwill and other unidentifiable intangible assets, which are often significant contributors to a company's overall worth, especially in modern economies. So this method explicitly values intangible. This should be intangible. It explicitly values intangible assets. That is the first advantage of the super profits model. The second advantage is that of the idea that above average returns must stem from some unique competitive advantage. Okay, which is a logical premise. Logical premise that above average returns must stem from some unique competitive advantage. You recall the example I gave here of company A and B. I did say that if these two companies have similar assets and they operate in the same industry, and company B generates more earnings than company A, then it means that company B could be having some intangible assets, which is a competitive advantage over company A. That's why this company may be having excess earnings, which is a logical premise. The above average returns must stem from some unique competitive advantage. It could be skilled management, it could be brand image, it could be anything that is intangible, because these companies are similar, they have the same tangible assets, but somehow company B generates more earnings. The earnings that company B generates in excess could be attributed to some intangible assets, and that is a an advantage. 3, it's useful for specific scenarios. This method is useful for specific scenarios. What does that mean? Now, it's particularly helpful or useful for valuing small businesses. You recall this is what we noted here. Small businesses and professional practices. It's useful for specific scenarios. It's useful or helpful for valuing small businesses, for valuing professional practices, or for specific accounting or tax purposes where intangible value is paramount and other methods might be less practical. Advantage number 4, advantage of super profits model. Do you have another advantage? ETC. Okay, we've identified 3 advantages. Let's move to the cons. What are the limitations of super profits model? The first limitation is subjectivity of inputs. We have 1, subjectivity of inputs. Subjectivity of inputs, you recall here, if I was to take you back to the calculation, we have some inputs that could be subjective, like the normal profits, the normal rate of return. Okay? There was an average somewhere. Average, we did have some average actual profit. There is some level of subjectivity in those inputs. The normal rate of return. Determining a truly normal rate of return for a specific industry and risk profile is highly subjective and can significantly impact the valuation. We have another input, the capitalization rate. This capitalization rate can also be highly subjective. The choice of the capitalization rate for super profit is also subjective and can vary widely among valuers. We also mentioned the maintainable profit. The maintainable profit, where is it? The maintainable profit, calculate the normal rate. The maintainable profit, we had a maintainable profit. Okay, the maintainable profit again can be highly subjective. Estimating a sustainable average actual profit requires judgment, especially if historical earnings have been volatile or impacted by non-recurring events. So that's the first disadvantage. 2, this method ignores future dynamics. The method ignores future dynamics. It ignores future dynamics. What does that mean? Now, the model is largely backward looking, relying on historical profits and tangible asset values. It may not fully capture future growth opportunities, strategic shifts, or changing market conditions that are critical in mergers and acquisitions. And that is a limitation of this method. The separation of intangible and tangible earnings is also a limitation. Separation, tangible and intangible earnings is a limitation. Separation of tangible and intangible earnings. Now, the underlying assumption that earnings can be neatly separated into those attributable to tangible and those attributable to intangible assets is a simplification. Separating earnings and attributing some earnings to tangible assets and other earnings to intangible assets is a simplification, because in reality, these are often intertwined. These two are often interconnected, not easy to separate and segregate and attribute some earnings to intangibles and others to tangibles, and that is also a disadvantage. Okay, another disadvantage is that this method is less common for large companies. The method is less common for large companies. That is why we discussed here in point number 2, when it is used, we said it is used for valuing small businesses, and that is a limitation because this method cannot be used when valuing large companies. For large, complex, and complex mergers and acquisition transactions, this method is generally not a primary valuation tool. In such large, complex mergers and acquisitions, the discounted cash flow method and market multiples, the PE ratio methods are preferred because they directly project total future cash flows and also market expectations. You understand? Then we can also mention something to do with the synergies. Does this method capture synergies? No, it doesn't capture synergies. This method does not capture synergies. Like many standalone methods, it doesn't explicitly account for the synergistic value that an acquirer might unlock, which is often a major driver of acquisition premiums. You understand? Yes, you understand. You've understood the entire lesson on valuation of firms using super profits model. We've come to the end of the lesson. In this lesson, we've described the super profits model as one of the many tools that can be used in mergers, in valuation of target companies for mergers and acquisition purposes. In this lesson, we've identified scenarios when this method is used. 1 is valuing goodwill. Number 2, valuing small businesses and professional practices. Number 3, informing purchase price allocation and dispute resolution and tax purposes. We've gone further to elaborate how to calculate the value of a firm using the super profits model. And here is the formula. The value of a target firm, the total business value, is equal to the net tangible assets plus goodwill value. You understand? And we did state that the super profit model posits that if a business earns more profit than what a similar business with the comparable tangible assets would normally earn, then the excess profit or the super profit is attributable to intangible assets represented by goodwill. That's why in this formula we have the net tangible assets plus the goodwill, which gives us the total business value. So we highlighted the steps prior to calculating the total business value. Then we've gone ahead and explained the advantages and disadvantages of the super profits model. In closing, candidates, it's important to remember that the super profits model, also known as the excess earnings method, is a specialized valuation technique that offers a way to quantify the value of goodwill and intangible assets. And while useful for specific situations like valuing small businesses or for accounting and tax purposes, its subjective nature and limited forward-looking perspective mean it's usually used as a supplementary tool in mergers and acquisition valuations, where the discounted cash flow methods and the PE ratio methods take precedence. So it is just used as a supplementary tool because the super profit model does not value the entire business. It only helps us to value the intangible assets of a business that is being acquired. So thank you for attending the lesson. In our next session, we will consider the next model, which is the capital asset pricing model. Then we'll go ahead and study about the discounted free cash flow basis method as other methods of valuing businesses for mergers and acquisition purposes. Bye.